Hi, welcome to my channel. Today in this video we'll speak about a company named Tatva Chintan Pharma Chem Limited. This is one of the specialty chemicals companies and it was listed in the year 2021. The last 1.5 2 years have not been very good for specialty chemicals companies as far as the stock price is concerned. So in this video we'll talk a little bit about the company, about its products, and finally we will talk about a very critical aspect of specialty chemicals companies, which is nothing but the operating margin. So this company was started in the year 1996. All right. They have two plants. One is in Ankleshwar, second is in Dahej. Both are in Gujarat. Okay. The company has focus on research and development, and this is evident in the product portfolio of the company, which we are going to discuss in a short while. Okay. Then the company focuses a lot of energy and their research and development capacity into something called as continuous flow chemistry. Okay. In this video we'll not be able to cover what is continuous flow chemistry. Okay. And finally the company is exporting its products to 25 countries including the US, UK, China, Germany, Japan and South Africa. So basically they have their business is export oriented is how I will put it, because they derive around 79% of the revenues from exports, right? Coming to the company's products, so they manufacture four categories of products. One is phase transfer catalyst, second is a structure directing agent, third are electrolytic salts, and fourth are pharma and agrochemical intermediates. So phase transfer catalysts are basically those products which are used for converting one phase into another during a multiple phase chemical reaction. Now what that really means is, assume there is a chemical reaction which involves more than one constituents, okay, and those constituents are in different phases. All right. So you have some constituents which are solid, some which are liquid, and maybe some which are gases, right? So these kind of reactions, generally how they occur is, all the constituents have to be homogenized and they have to be brought into a single phase. Okay. Let's say all the constituents have to be brought into the liquid phase, right? So bringing that, it requires something called as reagents or solvents, right? And these reagents or solvents, they are expensive, number one, and number two, they create a lot of waste after the chemical reaction is over, right? So what these phase transfer catalysts essentially do is that they reduce the use of solvents and reagents. All right. So they promote the reaction between uh, you know, one or more constituents which are in different phases without having the necessity of homogenizing the mixture. Okay. So that is the work of phase transfer catalyst. Now the market for phase transfer catalyst has been growing at a decent pace because of the focus on green chemistry and reduction in waste. Okay. So Tatva Chintan has a significant proportion of its revenue, around 23%, which they derive from phase transfer catalyst. All right. So one of the very important points which I want to bring to your attention from the annual report of the company is that the company says that phase transfer catalyst and almost all their other products, they have strong entry barriers. So let's see, what do they say about phase transfer catalyst. They say that consistent performance of catalyst is of immense importance for the customer, and this creates a need for consistent quality of the phase transfer catalyst, which in turn also creates an entry barrier, right? So what they say is that because the phase transfer catalyst is adding a lot of value to the customer by saving the cost to be incurred on reagents or solvents, okay, and also the quality of the product is very important, they say that the customer may not go very easily to a competitor, okay, to a competitor of the company, and that is why in a way this creates an entry barrier for the competitors, and this gives an advantage to Tatva Chintan as a company. Okay. Second category of product that they operate into is called as structure directing agents. Now what these structure directing agents do is that they promote, or they enhance the manufacturing of something called as zeolites, right? So these zeolites are products which are used in multiple applications, but they are mainly used in the automobile industry to reduce the emission, okay, to reduce the emission of gases, mainly the the nitrogen oxide and other harmful gases, right? So what happens here is the zeolites which are produced using structure directing agents, they are primarily responsible for reducing the emissions by automobile companies, and that is why the quality of these products is again very important, which in turn creates kind of a entry barrier for the competitors of this company. So this is exactly what the company says here is SDAs are key backbone in the manufacture of high precision zeolites. Any minor change in quality of SDA will lead to drastic failure of zeolite catalyst. Also, the quality requirement of SDA is very stringent, requiring multiple impurities to be controlled at low ppm level. To achieve such high quality product on consistent basis requires a technology to manufacture SDAs. The approval process of SDA is too lengthy and also requires multiple level of approval across the value chain. All these factors creates an extremely strong entry barrier for SDA, right? So SDA as a product, if you see, it has a huge revenue pie for the company. Around 52% of the revenues in FY22 they came from SDAs. Okay, talking about electrolytic salts, let me take you to what the company says about electrolytic salts is. So they say that electrolytic salts are used in the manufacture of supercapacitors. Now, what are supercapacitors? They are mainly used in in applications where the energy density required is very high. Okay, so in such a small supercapacitor the amount of energy that would be stored would be very high. Okay, and for this what they require is they require something called as electrolyte salts, which can, if the quality of the product is inferior, it will give an inferior performance for the battery, right? So the company says that the high quality requirements and consistency creates a very strong entry barrier even in this area. Okay. Now, a very important point to note here is that the company claims to be having a strong entry barrier for their products, but as an investor, it is important to analyze whether these products really have a high entry barrier, right? Because at the end of the day, all these companies, okay, all these chemical companies, they are kind of a commodity business, all right. So even if we call them, even if the company likes to call themselves as specialty chemicals, somewhere or the other the cost angle becomes critical for the customer as well. Okay, so let me speak a little bit about the margins of this company, which should give you a fair bit of idea about, is this really a commodity kind of business, how do the margins of the company look like, and what is the price at which you should be targeting to buy this company if you like this company. All right. So coming to the margins, now you see from 2011 we have the data available. All right, and the gross profit margins, if we see from 2014, you see the gross profit margin has been consistently increasing from around 38% to around 50%, and it is kind of stable in this zone. Okay, so for the last 12 months the margin reported is around 50% at the gross margin level. Okay, now coming to the EBITDA margin level, you would see that the margin increased from 2014 to around 2022, wherein they reported the highest EBITDA margin ever of 25% in FY22. But in the last 1 year, you'll see that the margin has been suffering a lot, and it is, the average margin for the last 12 months is around 16%. Okay, now that's a significant fall in margins, and because of which you would see that the EPS has also substantially reduced from 43 rupees to 20 rupees, right? So what is the reason for the fall in margin, such a significant fall in margin? So the company has given three primary reasons. Number one, they say that the product, the surface directing agents, which occupies around 52% of the revenue, it is a high margin product, and the sale of surface directing agents has been affected because of lockdowns in China. Okay, so apparently the company exports the SDAs to China. Okay, and because there were lockdowns in China, the SDAs were not used in the automobile industry, which is one of the main industries, target industries for the product SDA. Okay, so because of demand not originating from the customers, their facilities for manufacturing SDAs were locked in India, and that is why the margin has been impacted. Number one. Number two, the company says that they have to import a lot of raw material, they have to import a lot of packaging material to package some of the sensitive products. All right, so they are not allowed to use the local packaging material because of the sensitiveness of the products, and that is why the import of that packaging material, it costed them very high due to high freight cost. So after COVID, a lot of industries suffered this problem because the freight cost was significantly higher than what the companies were paying pre-COVID. So the landed cost of packaging material for Tatva Chintan was high, and because of which the company's EBITDA margin took a significant amount of hit, right? Thirdly, what the company says about the fall in EBITDA margins is that they are saying because of high energy prices, we have not been able to, we have not been able to keep the cost down, right? So number one, high freight cost, okay. Number one, low demand for SDAs. Number two, number two, high landed cost of packaging material, and number three, high freight cost, okay. Number three, high power cost. So these are the three factors because of which the company says the EBITDA margin has been down. Now, if you take a look at again the margin profile of the company, you would see that at the gross margin level, the company has not been impacted, right? So this is a very good sign, because if the company gets impacted at the gross margin level, it is more of a long-term structural problem for the company, right? See, high freight cost and high energy cost, these are transitionary problems. And from the conference calls, what I heard, the company is saying that we cannot go to our customers to time and again and tell them that increase the realization of the product because the freight cost is high, okay. They say that these are transitionary problems, and as a business we have to absorb these costs. So, in summary, what we can essentially say is that this is one company which operates in a space which has high barriers to entry. However, the last 2 to 3 quarters have not been good for them because of the cost increases. Okay, the fuel cost increase, the packaging material cost increase. Okay, and plus the slowdown in one of their main business areas, which occupies about 52% of the total company's revenues. Right, and finally, the company has announced its intentions of introducing new products in the electrolytic salts category. And this electrolytic salts category today is a very small proportion of their revenues. However, what will happen is the increase in electrolytic salts category revenue is going to reduce the dependence on the SDA business. So that's all I have for now. We have not discussed some points in this video because definitely because of the time constraint. If you like the video, do press the like button, subscribe to the channel, and do not forget to check our small cases. Thank you.